Hey everyone, Stock Market Trading Live, back at you with another one. Today we have a very interesting video. We're going to be looking at the type of returns you can expect from running the wheel strategy, as well as from running a covered call strategy, where pretty much you buy 100 shares of a company, and every single week or every single month you sell a call option. You take in premium, and we're going to look at what type of returns percentage-wise you can expect to get from running these type of strategies. So the results do vary. There's a lot of variables, but what I like to aim for is between 1 and 2% per week. However, it could be, around a 1 to 2% per month, depending on a lot of different variables. And for this return that we're talking about, we're not including dividends or appreciation in stock price. We're pretty much assuming the stock stayed at the exact same price and that it doesn't pay any dividends. I'm looking to get that 1 to 2% per week just in option premium. So I'm selling these options, collecting a premium, and aiming to make 2% per week in option premium. So I'll show you guys what I'm talking about, as well as use some live examples from trades that I'm currently in. So one of my current positions is British American Tobacco, ticker symbol BTI. Currently, I'm holding 100 shares with an average purchase cost of $35.26 per share. And pretty much the goal for me is to make $35 per week, at least, selling options on this stock. The tricky thing is that this stock only has monthly options, so I sometimes like to sell weekly options depending on how the price moves, but to only be able to sell monthly options does limit your possibilities. But once again, my average cost shows at $35 per share, but you have to factor in all of the profit that I've made selling premium, as well as this company is currently paying a 7.7% dividend yield. So not factoring in any of that almost 8% per year that's for free, which is, just under 1% per month on top of my option premium. Let's look at what type of returns I'm looking at on a monthly basis on my $3,500 investment. So going back to my trading history, I have all of my, buys and sells while running this strategy. And you'll notice I do make a lot of in and out trades for small profits, making $5 here, $10 here, $15 here. And doing that, it definitely adds up. I will say this is one of my lower return stocks. I'm not making 2% per week running this strategy. It's probably about 2 to 3% per month. But it is a decent return. You got to figure 2 to 3% per month is about a 24 to 36% return per year just in option income. Now you add in that 8% dividend yield, and we're at almost a 30% return on my $3,000 investment. So let's start back at the beginning of July. So in July, we purchased our 100 shares. Where is it? Right here on July 27th. We purchased, it looks like, about the majority of our shares here. And right away, we started selling call options. So we sold our first call option on July 27th, and we took in a $105 premium. We ended up closing out that position, buying it back for $64. So during that trade, we made a $41 profit in a matter of 4 days. So that's just over a 1% return. You have to figure a 1% return is about $35. So we're aiming to make $35 per week in premium. That would be 1%. So right here we made $40. Then we went ahead and sold another option for $35, which we then purchased back 3 days later for another $15, bringing our total profit from $40 to about $55. Right after that, on August 10th, we made another $15 of profit. We sold our $15 call option. We let it expire. We took the full premium. Now we're at a $70 return, all in a matter of about 2 or 3 weeks. Actually, it's about 2 weeks. So that's a 2% return in 2 weeks. And so that's just kind of an example of the type of returns that we're looking at. 1% per week, which is pretty much the share price. So if your share price is $30 per share and you buy 100 shares, you want to make $30 per week, because that would be 1%. So a perfect example would be AT&T, which is just about $30 per share, not to mention its 7% dividend yield. So we're also running this strategy on AT&T. So let's look at the type of returns we can expect from a strategy like this. Also, you have to figure, 1% or 2% per week isn't nothing to scoff at, but it's definitely, nothing to write home about. I mean, we have Tesla making 10% moves in a single day. So if you catch Tesla at the right time, you could easily make 10% in, an hour or a day. But for a safe stock on a safe investment like AT&T, which is paying dividends, it's nice to have that extra 1 to 2% per week instead of just your regular old 7% dividend. On top of that, it's like a second dividend. So in my opinion, it's kind of like making your dividend stocks work overtime. You're getting that overtime pay, you're collecting premium, and it's kind of like a second dividend. So going back, we got our dividend on August 4th. We got a $52 dividend there, which I usually don't factor in. That's just kind of, profit that I just leave and I reinvest usually. But going back to my original purchase of AT&T when we started to sell these options, we can start at let's just start here. So on June 26th, we have our call option expired. So we'll start on June 29th. We'll call it at the beginning of July. We'll go all the way through July and see our returns. So pretty much to start, we made $11. We sold a call option for $11. It expired on July 2nd. We took in the full $11 premium. And then on July 6th, we sold another call option. We made a $3 profit. We sold it for $16. We bought it back for $13. And we went ahead and sold another $31 call, which we ended up buying back for $10. So far, we've made $11 plus $3, bringing us to $14, plus $5, bringing us to $19 in the span of 10 days. So we're just under our 1% goal. After that, we made another couple of bucks here. So as you guys can see, I'm not going to, go through every single one. I'm sure if you guys want to, you can do all the calculations from me scrolling through it. But as you see, it is a consistent way to make a couple bucks here, a couple bucks there. Sometimes you'll get lucky, or you'll be able to sell an option at a high implied volatility and take in some higher premium. Like you'll see here, we took in a $32 premium. So these are the type of returns you can expect from this type of strategy. Now, if you look at more volatile stocks, AT&T is a low volatility stock. You're not going to get a lot of action out of AT&T. The calls and the puts aren't very expensive because the volatility is so low. The more risk you take, the more premium that you can take in. For example, looking at AT&T, Intel, we sold a option that is about 4 weeks till expiration, but we took in almost a $200 premium, which is about 4%. So within 1 month, we took in a 4% premium, which is great because, first of all, it lowers our cost basis and it mitigates our risk. So right now we're risking, $5,000 being fully invested. If this company went to zero, which is highly unlikely, we could lose $5,000. However, doing this, we reduced our cost basis by $200, reducing our max loss to $4,800, roughly. And now next month we can do the same thing. We can continue to reduce our cost basis, which is kind of the goal and the point, and it also lowers our risk. So the more risk you take selling premium on a more risky stock, the more premium you can take in. And now to close this off and to really talk about this is only one half of the strategy. This is a simple covered call strategy, but really it's a part of a bigger strategy. What I'm doing is called the wheel strategy, and using the wheel strategy, which starts by selling puts and not calls. For example, if I wanted to start selling calls on AT&T stock, I could either buy 100 shares and start selling calls, or what I could do is, instead of purchasing the shares, I could sell a put option, which would pretty much be the same thing, except if it expires, I don't have to buy the shares. I keep the full premium, and if it doesn't expire, well, then we end up purchasing the shares, which is what we were going to do anyway. So in this example, selling put options, usually you'll take in more premium this way. For example, if we were to sell our $30 put option, we would take in a $69 credit, which is pretty much 2% in 1 week. So you'll notice when you sell puts, you'll make more premium usually. And that way you can start with higher returns. So for example, if we sold this option, it would require $3,000 collateral. We would get $70 up front, which is about 2%. If it expired, we keep our money, we keep the premium, we make full profit. If we get assigned, well, then we own 100 shares at $3,000, minus our $69 credit, which brings us down to about $29.31 per share average cost. At that point, we could look out and we could sell our call option. We could sell the $25 or the $29.50 call option. We would take in a $50 credit, which is about 1.5%, and this is a weekly call option. So this is what the strategy is all about. This is a very rough and loose example. It can be a complex strategy, which would be very hard for me to explain in a small 10-minute video. But I hope you guys kind of get the feel here. Typically, you would start by first selling a put on the stock. If it expires, that's great. If you get assigned, that's okay also. But it's kind of a low-risk way to make money, to grow your wealth, and without taking huge risks that can risk your whole portfolio and stuff like that, which is not what we want to do. We want to make our money work for us slowly and surely, and build wealth over time. So this is what you guys can expect to run with this type of strategy. What I would say, once again, is to start by selling puts. It'll be very easy to get your 1 to 2% per week, and possibly even more. The trick with selling these options is you want to sell puts when the stock is going down, because it inflates the put price. As you can see, on Friday, AT&T had a red day, which caused the put options to inflate in price. So you'll see on Friday, the put options increased in value between 5 and 15%. So if I was to sell these options on Friday, I would get 13% more premium than on Thursday. So what you want to do is sell these options. If you're selling a put, sell it while the stock is going down, and the puts prices are going up. And if you want to sell a call option, for example, I sold a call option on SQQQ, which was up pretty big on Friday and all throughout this week. So SQQQ was up 4% on Friday. And you'll notice if I was to sell a call option on Friday, I would be getting 20% higher premium than I would have the day before. And the premiums are actually exceptionally high on a stock like this. So you'll see what I'm talking about. When we take more risk, we get more reward. SQQQ is a leveraged, highly risky asset. However, we could sell a weekly call option and take in 5% right off the bat. On a $24 stock, we are taking in a $124 credit right off the bat, which is pretty much 5% in 1 week. That's a great return. And if you could do this every single week, you would get magnificent returns, and that's what it's all about. So sorry, this video is kind of, might not. Hopefully you get some value out of it and get the rough idea of what we're trying to do here. There's a lot of questions that you might have, and if you have any questions, definitely feel free to comment or reach out to me, and I can explain the strategy, in more detail. However, I've made in-depth videos talking about covered calls, cash secured puts, the wheel strategy, so I definitely check out those videos so you can fully understand how the strategy works before you start trying to make these returns and getting into trades you don't fully understand. If you don't understand what you are doing when you're selling a call or when you're selling a put and the type of rights you are selling to another person, you should definitely understand this before making these types of trades. So as always, guys, thanks for watching the video. Hopefully we can continue to make these returns, keep the portfolio growing. We've been making excellent returns so far in 2020. Our strategy has been paying off. I've been waiting for a dip. The dip has finally came. We've been building our position in high quality names. We have Apple, Microsoft, AbbVie, AMD, Google, Pfizer, all of some of the best companies, PayPal. So we're starting to build some very strong positions, and I feel very comfortable with our current investments. So thanks for watching, guys. Smash that like button, subscribe to the channel, comment to enter our 1,000 subscriber giveaway, and we'll talk to you guys soon.